Well, I hope now I've sorted out the problem that held me back the other time I started presenting this. And just as the topic suggests, um, in this video, I'm considering analysis of data, and more specifically, the inflation rates data that we have been using in actually we looked at it for the first time yesterday, and the data that I picked, the data of concern that I picked is that spans from the year 2000, January 2005 to December. Actually, the actual data span to from January 2005 to January 2025. But for some reason, I truncated it so that my data is ending at December 2024 for a reason that I'll explain later. So just as we looked at descriptive statistics yesterday of the data, of the inflation rate data from the Central Bank of Kenya, yesterday I showed step by step how I got to the website of Central Bank of Kenya, how I downloaded the file. I downloaded the Excel file. After downloading the Excel file, I also showed how I brought it on board using a code, specifically this one, code that looks like this one here, this code here. Then we looked at descriptive statistics involving, say, the mean, standard deviation, and where standard deviation gives us an idea of what the historical volatility is. And I also went an extra mile to show the comparisons between the regimes of our presidents. Particularly, I showed what the inflation rate was in the last regime of President Kibaki. Then I also showed the comparison of the inflation rates for the Uhuru 10-year government. So that is part of what I did in my video yesterday. And if you would want to have a look at it, then you can visit my website. You'll see it, and you'll find it there. So today, this is a continuation. Today, I want to forecast, because yesterday I saw, by going through the data, we saw that the data is stationary, and the model that we used also kind of confirmed that that our model, the model that we had fitted using the data, we can rely on it since the data is stationary, and we have also seen that the volatility is not so wild. So on that basis, I want straight away. So today I've brought the codes on board, and the reason why I've brought the codes on board, I really don't want to spend a lot of time having to type all this. Just as I said, this part here refers to the library. That's the library that I actually those from those libraries I'm able to interact with this environment, so that I get my commands done. So I have to import these libraries before I proceed. Just a moment. Epic pen. Epic pen, if I will get it. Yes. Epic pen, let's see if we have it. Epic pen, it should be there. Now, whichever way, we don't want it to interrupt again. So for that reason, we can do without it. If it means having to hang, then we don't need it. So what I was saying is that here, import NumPy as NP. So NumPy pandas, this will help me interact in mathematical and statistical environment. Import OS allows me to specify the data path. So it allows me to interact with operating system so that I capture the data set where it is. Now for visibility visualization, data visualization, I'll bring on board useful tools like Matplotlib and Seaborn to assist us. And for data training, okay, we'll also perform here, we have to perform time series analysis because we are going to predict volatility, and having predicted volatility, we are going to be interested to see what the inflation rate is likely to look like in the year 2025. Now, it should be noted that this analysis, we are dealing with the data as it is. So the main assumption of my result here is that it gives me, the main assumption here is that I'm using the data. So all response that I get are as real as what the data depicts, since I'm using real data. So whatever analysis that I shall have given, whatever the figures that I shall have given, those are not my statistics. They are not my statistic. They are actually statistic generated from the data. So straight away, I run the first cell. Yeah, so I'm running the first cell by clicking this. So I'm using Python. This is Python environment. Specifically, I'm using JupyterLab. So JupyterLab allows me to interact with Python as a programming language. So we can see, if we look down here, we see it's still busy. And if that is the case, then we'll wait until it gets idle, because it's only ready when it's idle. So we can give it time. Yes, it's still processing, busy. So it's still taking in the command. So once it takes in the command, then my next step, if you look at this code here simply specifies the fact that actually it's a code instructing it to check, because this here provides the file path. So I'm asking it to check if my file called inflation rates exists on the desktop. And you can see that I've given the path because desktop is on the local disk, which is C. And then we go under users. Under users, you choose Collins. That's the name of this machine. Then we get to desktop. Then there we find the inflation rates data. So this is how I saved it. So this is the name of the data as we had used it as we used it yesterday. So let's see. Again, the machine is taking long. I don't know why that would be so, but let's see how by the time it picks it up, then we'll be able to proceed. Be able to proceed with speed. So probably as we wait, let me see if, but then I didn't want to get there because that may slow down the machine. Since the machine is already showing signs of some load. So let's wait for this cell to run. So it's writing busy here. So that means the virtual machine is still processing the command that I've put, the first command that I've run. I've run this first command. So I want it to instruct me that it's taken the command. Then I'm able to move after that. Before the command is taken, then the next command may be misinterpreted. So it first has to inform me when the command is taken, then I proceed. Now, majorly what we see in this data set is that the average volatility, we are going to consider here what we refer to as the 12-month inflation rate, and that's what we are going to use to get to forecast, to predict. So probably let me get here as we wait for the machine to finish processing that bit of the command. Let me get to Central Bank website. Central Bank website. It's dragging. Well, if that will cost us time, then let me proceed with this. That will cost us some time, as I've already seen indication. Then we better proceed with this. This as well is taking long. The machine has taken so long today, like it's not behaving. It's picked it. So that is picked. And if it's picked, then I just redid it. So what I need to do, let me remove this. Yeah, so that I'm left with this. So I run again this. So that second command, the second command that I'm reading, it's loading as well. It's that of where I'm instructing the machine to check if this file named inflation rates in bracket 2 exists in the file path. And more particularly, we are asking it to read it in the data frame, and it's an Excel sheet. And in the event that it scans and fails to find it, it should print to me. It should print out file not found. So this means that it has already scanned, and the response is that the file is somewhere. Since it's not written, it's not given us any response after running this cell, it's not told us file not found, because the instruction here was it should scan the file if it's available. Should it be available, then it moves on. Else, it prints file not found. Now that we don't have such a printout like file not found, we know the data exists somewhere. But we can check how if the data exists, and probably what I do is bring another cell like that, and see. I call for data frame dot info. I want to see if the data set is available. and to see if the data set is available. Since it's not given me back file not found, so I know it's available, and I just want to see some information about it. Let's see, it's working on it. It's busy working on it. I know by the time it's done, we'll be able to see something here. Exactly. So we see that our data, we have got 241 entries. That is the first entry correspond to serial 0 up to the last entry, 240, first entry corresponding to 240. Now columns we have, the columns we have year, we have year, we have month, we also have annual average inflation and 12-month inflation. Now, for our purpose of forecasting, we'll be interested in 12-month inflation, because this is what is likely to give us a more reliable picture of the data. And in my yesterday's video, I also discussed more about the descriptive statistics of the data. So that is the DF describe. Yes. So I delved so much. Actually, I considered this so much in my initial video, where we were looking at the descriptive statistics as of annual average inflation, giving us a mean of 7.643 and standard deviation 3.29. So these are historical mean, because data is averaged from 2005 to 2024 December. So this one here, the mean for annual average inflation is 7.643154, and standard deviation is 3.293158 for annual average inflation. But we are interested in this column of 12-month inflation. So here we see that the mean for 12-month inflation is 7.431286. Standard deviation is 3.925843. And the minimum for that is 1.85. The minimum of 12-month inflation is that. And so this we discussed in yesterday's video, so that's just an overview. And I discussed what these values mean in terms of interpreting them, what they mean for the economy. So you can check the video on my channel, and so that you connect the dots between the first and this. So now I'm sure, and I know that I have my data. So the next thing that I'm going to do is to convert year and month to date time. Why do I need to do that? Because look, I also have this. Let me see this again. If I populate the data, so that is df dot head. If I populate the data, there is something that you'll see. You'll see, because I'm taking the data raw as it is from the website. So there isn't much I've done from it. All I did is to download and store. So now I have it. Now to see what it looks like, what the data looks like, if you are to have an Excel sheet view of it, this is the data. And you see this is how it's arranged. The arrangement in the Excel sheet is such that the first entry is 2005 December. That is the first entry, having annual average inflation of 9.87 and 12-month inflation of 4.70. But now it would be more prudent here, because again, here we see under year, we have got these entries which are repetitive, and then month, we have got them in terms of string: December, November, October, September, etc. So it would be prudent then to find a way of having to represent these dates, so that year and month are defined in a manner that we have a sequence, a date that is sequential. So that my data, if I'm to check, should give me something like, if I check for the data frame, if I check for the head, I should be able to get the first entry here being 2005 January, an entry corresponding to that. But that's not the case. Now that's why I need this particular command, this command here. Now running this command will kind of help me change the data into what I want. So let's see, it's running, and you can see convert year and month to date time format. So basically that's what I'm trying to do, because that's what will allow me to check what the inflation series looks like for a 12-month period. So let me check again. Now that I've performed that operation, let me see if it's changed anything in our data. So let me see, let me just do df head again, df.head, df.head, df.head again, and I see if I run it, if I run it, this is what I see. So we've changed it, that code has changed it, so that my first date is 2005 January 1st, and the entry is 12.27. The second is February 2005 March, it goes like that. So I could check, say for the first 20 entries, and see how they move. And you see this is what the first 20 entries look like. So my data series now in the data frame is arranged in a pattern that I want to see, so that we see January 2005 posting 12.27, while 12-month inflation posting 14.87. And we see the data running in this series because I take the first 20. This is how it moves. You can see as running from January up to December. Then we start again January 2006, and we move sequentially as such. So it means this column date is what we need for us to understand the data. Now, with that understanding then, I want then to consider what we refer to as the series, the time series of this annual average inflation and 12-month inflation. This again I covered in depth. I covered it thoroughly in the last video. You can check if you have time. And just remember that with this, which I'm doing is live analysis of data. And the data, I'm not the one generating, I'm getting this data from public repository. And this data are data that are public. Anyone can access. And you saw how I accessed the central bank website and obtained the data directly. And now I'm trying to make sense out of it. So with that which I'm giving here is unbiased analysis. It is live analysis which is unbiased. The figures that we see, once we get them, we just make meaning out of them just as we see them. So let me see the plot. So it's working. It's working. Still busy. Still busy. Let's see if it gives us the plot. Let's see. Expect. Yes, as we wait for that, we can still see what we have here. That we have inflation rate. There were times when it was like 2005 August, it was 14.53. Now, the highest we could see. And that's why when I pressed describe here, you were supposed to see the maximum it ever hit was 17.07, and the minimum it ever was 3.93. And for the 12-month inflation, the maximum was 19.720, and the minimum is 1.85. Now I'm just taking you through that as I wait for this to, for the machine to finish up or that which it's doing, the operation that it's performing, and I see it's finished. So this is the curve that, this is actually the plot that I showed yesterday, and it's a time series plot of annual average inflation. Time series plot of annual average inflation. So we can, so this is what it is, and we see this is what it, that's what it looks like from 2005. We see it getting a surge, and so we see a lot of variability just before say 2013. By 2012 there was still much variability, as you can see. Then kind of it tried to stabilize. Let's see what that of 12-month inflation will look like. So 12-month inflation, let's see what it will look like. 12-month inflation. So 12-month inflation. 12-month inflation. I hope I've captured it the right way. Then the label should be 12-month inflation. So we want to see the series for the 12-month inflation. Month inflation. I hope I've captured the spelling right, so that it does not give me an error. Let's see what it gives us. Yeah, so that was for the annual average inflation. The other one was for the annual average inflation. But this is now a time series plot for the 12-month inflation. So we see 12-month inflation. This is its behavior. This is how it behaves. That is the series, as we see. So that is that. And next, the main purpose of having this this presentation was to actually talk about volatility. So we need to estimate what the volatility is. So we calculate historical volatility, that is the standard deviation of 12-month inflation, since we intend to carry out our analysis, our forecast based on the 12-month inflation. So my next code will actually calculate the rolling volatility, e.g. 12-month rolling standard deviation, and that is what, okay, we'll see for 1 year rolling, so that we'll see, we'll have another column for rolling volatility. So let's see, let me run the code so that we see what it gives us, because this code is expected. You can see I'd run it, that's why you see this, but let me just to ensure that the code is proper. We run it to see what it brings. So here we see that the historical volatility, we have, just a moment, it's still running, it's still busy. It's still busy, but even as such, we can still get, yeah, it's done. We see historical volatility, it had calculated the historical volatility while it was still drawing, that the historical volatility standard deviation is 3.93. That's what we can see. So the blue curve here represents 12-month inflation. And we can see from 2005, that has been its behavior, quite erratic, as you see, with some wide volatility, up to some point from, say, just after around 2013, when we were having Uhuru coming to power. And it should be seen that this volatility, inflation rate and volatility over time, It's kind of behaving from 2013 owing to the policies and measures that were put in place to control it. So we see that it's having a kind of a better pattern from 2013, around 2013. We see that, and then at some point, it's kind of, at this point, it's more packed. This is better, but that's what it is. But it's been, the inflation rate has been going down. That's what we see. Now, 12-month rolling volatility. Now, this is what it is. So this is what it is, the difference. If this is the rolling volatility, then one would consider the gap between what the actual is saying and what the volatility is saying. So, and realize that we said that the historical volatility is 3.93. This dotted green line, if you check keenly, you'll see this dotted green line. So it's just at that point, 3.93. So it means that this, the volatility of 3.93, which is this, you see this particular, the rolling volatility. If you look at it, kind of much of the points were falling. If you look at the flow of the curve around this straight line of the volatility, you'll see some pattern from up to some point up around 2013. Then from that particular time, then you kind of see volatility that is below the volatility that, if you look at it, you see much of it now is below 3.93, which was expected. And that you saw in the time series, because now if the volatility is below 3.93, then it means that we are having kind of more predictable inflation rates. So that is that, and this is what it is. So up to 2024, we see that inflation rate, this is what it looks like. It looked like from 2005, it moved, and we are having some form of predictability or stability. Let me talk of stability from around 2013, and it's on a downward trend. Now, looking at this data, the other claim was that their inclusion of some products or services in calculation of inflation rate is seen that some of these products or services have high volatility, and hence gives a deviation from what is referred to as the core inflation rate, and that necessitated having to harmonize this. And this kind of suggestion is actually a recommendation by the World Bank, which had been adopted by the East African Community, and now Kenya the other day showed efforts to align to the same, that of having to exclude, say, services like matatu, say bus fare is considered so volatile, and price of maize is also considered to be so volatile. Now that prompts me, now that I have the data, inflation rate, I want to check the stationarity, so that I see what actually the influence of such kind of, because up to just 2 weeks, before 2 weeks ago, before that particular decision was made, we have been collecting this data with all those products and services which are seen to be having a lot of volatility. But then let me see if our data is stationary. So I want to check for stationarity using the ADF test. It will tell me if my data is stationary. Now, stationarity should mean that the data, the inflation rate has got some mean, and it actually, I would say it oscillates around that mean. It can go beyond it with a specified, it can go above it with a specified volatility, or come below it, or come down with a specified volatility. But every other time it will just be revolving or oscillating around that particular mean. And so that if we consider a Brownian movement of that particular process, we would expect that in the long run, the change in the movement or the differences in those movements should give us a zero. So let's check If we find that there is stationarity, then that's okay. And if we find non-stationarity, then it would mean that we need to employ more techniques, those of, say, differencing, so that we remove patterns which are, say, periodic patterns. We remove patterns, so that we remove patterns, shocks. We remove the shocks using differencing. So first, let me run. So it's still working on it. Still working on it. It's working on it. Let's wait and see. Yeah, so I'll check for stationarity, and here again I'll be asking it the same code will also forecast. The same code will also give us an overview of the forecast. So this code is as you can see, it's made up of several commands. The first command here is checking for stationarity. The second is saying if non-stationarity is seen, then apply fast differencing. Fast differencing here, optimization. I think that is another class that if one is interested can book a different class. So then after that, you check stationarity in inflation series, as we have seen. So then plot autocorrelation to identify ARIMA. So here we are ARIMA order. So we are autocorrelation should just give us the way the data interacts with itself. So let's see. I think it's still busy. Then we'll print the model summary, then forecast for 2025. And this is the main reason why I brought up this presentation, because I wanted us to see what is likely to be the forecast for 2025. I can see what it's doing now. It's just attempting to draw to give us diagrams and tables, and it's already given us results for the ADF test. And the test statistics, negative 3.1943 with a p-value of 0.0203. Now that allows us to conclude stationarity. And let's see how these are interpreted. This I discussed in depth yesterday, what it means when we have a negative. A negative simply points to the fact that there are residuals, but whether they are significant or not, that is what we gauge by comparing the p-value with the one we had set here to be 0. We had set some value here to be 0.05 here. So we compare it with that. So that is that. Then autocorrelation plot of inflation rate. Now look at this. This is now the autocorrelation plot of inflation rate. Now I don't want to get into much explanation of that, but that is what we have. So you can see that we have two points defined. There is this point represented by the dotted line. Then there is another one. This one is below the 0. The other one is above 0. But if you check keenly, you'll see that it's a constant deviation around the 0 mean. So it's the 0 mean I was referring to. That is in the long run, the rate of change is expected to oscillate around the mean, and this is how it's been behaving. So before we saw a behavior where we could have observations which are beyond, are outside the upper limit, and we could have some below. But we see that in the recent past, the behavior has just been contained within the mean, which is defined to be 0. And this tells us that our model is reliable. We can rely on it to predict future inflation rate. So these again are some of the results that corroborate or confirm that they confirm that our data well fit, and so we can rely on it to make predictions about what in future. But then again, this is based on the data that we have observed up to this particular point, so that if the economy were to continue the way it is without shocks, unexpected shocks, then we are expecting that trend to continue. So that we'll be seeing an inflation rate that stabilizes at around 3%. Let's see. So that's what we have. Is it finished? It's still working. Yeah, that's why it's not given me every other thing that I needed. It's not given me all the data yet. So we'll give it time. Though up to now we have seen where we are headed. We have seen what it means. So it's finished, and that then allows me to start looking at the other contents. Yeah, you see, it's finished, and we see that inflation forecast for 2025 is already given, and we say forecasted inflation. So you see that we see that this is the pattern. This is how it's been. This is the plot that we have had since 2005. This is how it's been behaving, this way. But then we see our prediction, since this is a prediction which is based on the volatility that we have described, we are seeing that the forecasted inflation is expected to stabilize. And this is so because we are basing it on the data that we have had up to from 2005 and the behavior. It should also be noticed that such kind of process also depend more on the most recent data than on the relatively past data. And so that's why we are seeing that this particular curve, for our forecasted inflation, it kind of appears to have stabilized, but we may expect some zigzag or zigzag. If there are shocks that takes it to the negative and positive end, we may expect some zigzag. But the inflation rate is expected to be contained within a level where if you work out the mean of the changes, it will just lie along the forecasted inflation. So let's see. We forecast that January inflation from the data, that is from the data that we have collected, that the Kenya, Central Bank of Kenya has collected so far from 2005 up to 2025. Now we are forecasting inflation rates for 2025. So for January, the forecast is 3.078. February, it should be 3.191. Then March, it's 3.12. 2025, 3.12. And then we expect it to stabilize at around 3.13 towards the end of the year. So basically, that's what I'd wanted to confirm, that as much as our government is ambitious in trying to control this rate, the data speaks for itself. Data is on the side of the government, and if right policies are put in place by the government and decision makers, that is the Central Bank of Kenya, that enforces some parameters in terms of key inflationary or monetary policy directions, then we are likely to see stability and have an inflation rate that is controlled. So that was just the main purpose of my discussion today. But then something has come up that I forgot about. I need to, yeah, if I check describe, if I have describe somewhere, let's see. Yeah, so up to there I'm done with what I needed to do, and I just wanted to check something here because there's a command that I had before. Let me see what it gives. I want to check describe after running that command so that I see. So df describe, when I run it, df describe, when I run it, it's loading. Yeah, see this? Yeah, this is having given another command, and here we have what we refer to as, you see that here, having provided that other command, then there's another column that we have added referred to as rolling volatility. And we see that the mean of rolling volatility is 1.87. Realize that the mean of rolling volatility, this now is worked out from the 12-month inflation. But the historical volatility, we had it to be 3.93. So there's a difference between such. So what we have is that what we constructed was a ARIMA 1.1 model, and that is what has given us the results that we have. So there's a lot here. There's a lot like there's a lot of output here that we may not have to take. For our purposes, I know much of my viewers are not interested in all this, but rather understanding the data. But if I should just briefly mention what these are, these Sarimax results, we see that the model we have used is ARIMA 1.1, and somewhere we see AIC. Okay, log likelihood is negative 359.668. So this is how log likelihood is a measure of how well the model fits the data. So since it's negative, it indicates some residual errors, but this is expected in economic time series. Yeah, so in economic time series we expect such, and so that's not a big deal. But then we also see AIC. AIC here means archaic information criterion. Here we see archaic information criterion is 725.336. So lower archaic values indicate better model fit. So the model's AIC is moderate. This is moderate. 725 is moderate, suggesting a reasonable but not perfect fit. Then we have BIC, which is the Bayesian information criterion. BIC. It's also 735.778, which is close to AIC, that is archaic criterion. And so similar to AIC, it's used for modeling selection. And so it's higher than AIC, but still within a reasonable range. So that's also okay. Now, we see if we move here, then we see again some entries, and we see entries like 0. That is for AR, that is autoregression. Here we find a value of 0.3430. So we need to check this, whether it's significant against the, if the p-value is less than 0.05, which we had specified in the command, then it's significant. But in this case, we see the p-value is actually less. So it is significant because we are having a p-value of 0.015. That's what corresponds to it. So that means that it indicates a moderate persistence in inflation changes, this value. Moderate persistence in inflation changes. And inflation has some dependency on previous values, but not overwhelmingly so. So that's the interpretation of this particular one. That it indicates that value that we get here And since the p-value has given us a go-ahead that it's significant, then what it means is that it indicates moderate persistence in inflation changes, and that inflation has some dependency on previous values, but not overwhelmingly so. Then I have MA, moving averages. So again, coefficient, MA coefficient. MA coefficient is 0.0292 with a p-value of 0.844. So again, this is not significant because we are comparing it against a p-value against a significance level of 0.05. So that is not significant. So the short-term moving average effect is weak. What we are saying is that the short-term moving average effect is weak, meaning random shocks do not significantly impact future inflation. Random shocks do not significantly impact future inflation. I'll be giving this in a report form so that one can refer to it each and every other time. Then we've got sigma squared, which is 1.1720, and the p-value is 0.000, which is highly significant. So this sigma here is highly significant. And now what it's telling us, it represents the variance of the residuals, indicating a moderate level of noise in the model. It represents the variance of the residuals, and it indicates a moderate level of noise in the model. Then if you move here, I'm just trying to explain. I'm done with the projections. That's the forecast. So I'm just trying to, for the viewers who are interested to know more, I'm just trying to make sense out of the table so that you know what they mean. So again, we have here this one called the Lejeune box, and it's giving us, that is for Q-test, and it's giving us now probe Q, we are told is 0.98. So this is test for autocorrelation in residuals. We are just trying to test for autocorrelation in residuals. So a P of 0.9, a P value of a P of 0.98 is definitely greater than 0.05, which we had set at as our significance level, and so we are saying no significant autocorrelation. So the model is well specified. Our model is well specified. Then we get to the JB. We also had the what? The JB, that is the Jake Bira, this one here, and it's giving us 155.18 as the value, and probe of 0.00, that is the p-value. So again, this tells us that residuals are not normally distributed. The residuals are not normally distributed. So potential issues with assumptions, the assumptions that we have. So the residuals are not normally distributed. So there are potential issues with assumptions of our model. That's what it's saying. Potential issues with our assumptions. And now, heterosedacity, that's what we have here. Heterosedacity, we find 0.25 as the value, and the p-value is 0.00. So this indicates non-constant variance, non-constant variance. The variance is not constant. So this is what now, so that's the level of heterosedacity that we see in this data set. Then we have, so that indicates that inflation volatility changes over time, possibly requiring further model adjustments. So inflation volatility changes over time, possibly requiring further model adjustments. But then here, much of it to decision makers, the understanding that we should have here is the consistency in implementation of the policies that either originate from the CBK or the executive orders that create the business environment in the country. So that's that. I can move again. So I think I've explained all that I needed to. and that's just what it is. So we are saying that the mean historical inflation was 7.43 that we saw from the descriptive statistics. And what we are saying is that the model assumes that inflation volatility remains stable. But real-world shocks, e.g. political instability, global economic downturns, etc., could disrupt this trend. So the trend that I've just given here, this, of saying that the inflation rate in January to be 3.078, 3.1, etc., up to December 3.12, they are pegged to the status quo, which is unlikely because we expect a lot of shocks along the way, which could be economic, political, in terms of policy change, direction change, etc. So up to there, that is the analysis that I intended to give on this particular subject. So I beg to stop, and probably we meet again tomorrow for some more in-depth analysis of the same.